You know, it's common to introduce yourself at the beginning of every video, but dang, I know who I am, and if you're watching the video, then you know who I am as well. So, but if for those that are first to actually watch this, then my name is David. My nickname is Tiger. Um, I guess because of the moniker that, well, I was a redhead growing up. That has nothing to do with being a tiger, though. But anyway, I was working through a scenario. Well, I guess I was doing some back testing of my trading strategy, and occasionally this kind of scenario comes up, and I really wanted to. Well, I thought it was good enough that I wanted to share here as I've been developing my trading strategy and put it together. I thought that I don't know what kind of work you put into yours, but obviously when I'm working it out, and I guess at this point, it's that point of being frustrated, and you get to that point of frustration where some trades just get away from you, and there's not really, and you try to curve fit them into your strategy so that you can sit back and say, well, if this happens, then I will account for it this way. And I think that you can over strategize your trading strategy in that sense, is that you can over optimize it. And this is I believe on February 6th of 2012 is a beautiful example of, at least as it applies to my trading rules that I've been developing, that you can over strategize or over optimize a strategy just to curve fit it into your plan. So I'm going to pause. Well, actually, we're looking at 8:30 in the morning. I'm going to go ahead and fast forward out to the time period I want to show you right now. I want you to pay attention to this bar right here. That's over 400 right now, and I'm classifying roughly around 390 or higher is something I should be looking out for. But this bar right here is the bar that is clearly over the 400 in volume mark that I'm showing. And then we're going to take a look at this entry point that's going to come up here, and where it can be deceiving, I guess. So let me, well, for you, it'll just be me talking at the next part of the tape. But anyway, after I unpause it and come back live, you'll see that where I'm talking about. Now, obviously, I'm doing this because I'm limited in YouTube to 15 minutes, and it's unfortunate. I guess some of the people that have some kind of professional account or whatever, a guru, I think, is one of the classes you can be at YouTube. You can get longer videos. I know some of the traders out there, I've seen, there's some really good information on YouTube, obviously, and I don't need to tell you all that. But it's just one trader sharing his trading ideas. That's kind of how I started in the if you go back and you want to go from the very, very first YouTube video that I put out, I wasn't supporting any company or any trading company, or I think I got lost in the work there somehow, and not sharing as much as, well, obviously we have our secrets, right, and we're going to die with our secrets, but there's some things that I believe that can be shared as a trader, and one of them has to do with a concept that I call having enough room for profit to initiate a trade. I call it NERFP, NERF, with a P on the end, NERFP. And that's one of the overriding questions that I always put on every trade, is that, do I have enough room to initiate that trade in any particular trade that I take on? As you can see, the replay right now is about 8:44 a.m. I'm going to get over to the open outcry of the crude oil market. By the way, this is the crude oil market. It's my favorite market to trade, the crude oil market, CL. Guess I can share this particular point of my trading strategy with you as far as CL goes. The crude oil market is that I look for my opening trade when the crude oil market opens. So I know it's open and it runs basically 24 hours around the clock, but the open outcry here in the United States starts at 9 a.m. Eastern Time, or 8 o'clock Central Time. I guess that would be, what, 5 Pacific, and GMT minus 5. So that's about what I look at. So my time zone where I live in Western Pennsylvania it's 9 a.m. and it goes the open outcry of the crude oil market on a daily basis, Monday through Friday, not take into account any holiday. And by the way, here's a little point to holiday. I know we're coming up to a holiday here on President's Day, which is the 20th, this Monday coming. Even if the market is open, I never trade a holiday that's marked like President's Day. Last in January there was I guess Martin Luther King Jr. Day. In March or April you get Easter and Good Friday kicking in. So there's certain days that you want to, and some traders take off the Friday. It can give you a nice 4-day weekend. So you could have, especially over this last, I didn't trade Thursday, Friday. I'm off Saturday, Sunday, Monday. And the next trading day is actually Mardi Gras Day on Tuesday, and Ash Wednesday on Wednesday, and so forth. So don't want to waste too much of my 15 minutes. So let me pause here, and we'll get to where I want to show you. Alright, right now what we're looking at, this is the market, as you can see here on the replay. Let me just pull this up on the screen because I can move it around. It's 9:03 in the morning. The open outcry has initiated, and the open of the crude oil market is now open. Now what you're looking at on the right hand side right here, if I click that, that's going to show up in Camtasia Studio. This is a 200 trade chart right here, and I like the trade charts, and some people like range charts, other people like candlesticks, and some people like the way I look at it and whatnot. This is a volume. This is kind of proprietary information kicking in this way, but most programs have volume, so you can color your bars however you want. I put a moving average in, and you can do whatever you want with that, but this is volume. I'm a huge proponent of volume. I mean, if you don't know that about me by now, then go back and look at some of the videos. Everything I do goes around, I guess, 3 key principles, right? Cut your losses short, take profits on, cut your losses short. Part 2 of that is to take, I can't even remember my own frickin' rules. Let profits ride or run, and then take profits on the ride. I mean, I know them off like the top of my head, but anyway. So this bar here is a 400 plus bar right here. So the volume, and if you're looking at why is that significant for me and what I'm looking at, this is a 200 trade chart. So basically, if we would trade, way I understand it, if it would trade 1 contract per 1 tick, then it would only be 200. And for instance, you would see it 200 right around this area right in here. Volume of 200. Here's 250, 300, 350, 400. So, a normal, you would think that the volume, and this is the argument that I got in with another trader, you'd think that volume would be equal, 200 ticks equals 200 contracts. That's not actually true. 200 ticks is not 200 contracts. Sometimes you can see like footprints in the sand. You can see where some traders have initiated more than just 1 contract per 1 tick, right? That's what you're looking at here as it relates. Whoops, I think I just fast forwarded to God knows where at this point. Hold on. That's what happens when you get pushing buttons. Next thing you know, you're not where you want to be. So you can see where the volume is kind of kicking in, right? So if this is normal volume down here, this would be like 1 tick per 1 contract. And this is like the normal. And then you have your abnormal volume, I guess, for lack of a better way of saying it, where it kicks out. And here it kicks out, and you start seeing that footprint in the sand a little bit. You can see that you had high volume, but the market continued to move down. Well, I would say that this is some particular trader, or maybe a group of traders that are in here, and they've initiated what I would consider they're actually buying into strength. So in other words, buying into weakness, not buying into strength. So the market's pulling down here, and they've initiated whatever program they're looking at this point, but they've started initiating their buy sequence, and you can see it with these high volume bars that you're starting to see. And I don't really pay attention to the coloring of the bars. Just look where you can start to see the particular area right here. They're starting to initiate buy sequences here, and it's all basically culminating right here. This ends up being the bottom of this trading day here at 2.6, and it also coincides, doesn't always happen this way, but also coincides with the low of the previous day. So that not necessarily always the truth, but this day it does happen. And on this, I think this day is a day that, no, 7th heads all the way up. This day does go up into this area right in here. So what I'm gonna, curve fit in a strategy, right? Now I know what happens on this particular day, but I'm also know what I'm trying to look for as far as my particular trading strategy. Maybe you can curve fit this day to make it work for you, but I'm still working on how, if I over optimize a trading strategy, this is where you can get into problems, right? If you over optimize a trading strategy, you can get yourself in trouble, because then ideally you might be taking trades that you shouldn't be taking, right? So for instance, if you're taking a trade somewhere between 9 and 9:30, I'd argue that some of those, most of the time, that is not going to work out for you. You're going to get in, and then it's going to retrace back to you before the open outcry of the stock market kicks in at 9:30. So where do you find that strength to pull in to the market? Now you can see the footprints in the sand here, and is this the bottom? Well, you could have argued, if we would go back in time before you saw the left edge of this, here is what you're looking at right now. Okay, this is the high volume kicking in, this must be the bottom. And then you can see that no, that's not true. It just takes it off and moves it on down, right? Whoops, did it again. So alright, so let me pause this here, because I'm trying to get this explanation within 15 minutes for you, and move the tape up, or the recording a little bit further out. Now as I'm moving it out, it's that give and back process. I've been doing this for a long time, been trading, and my nemesis obviously has been the day trading arena. I've been successful as a spread trader, a positional trader, options trader, and the whole realm. It's been the day trading realm that, the challenge from Larry Williams, I guess, for lack of a better way of putting it. Larry will say that all day traders are losers over the long run. So even if you look at his performance back from when he won his contest and won, got the 10,000 to $1 million, one of the facts that's not really widely spread is that during that contest, even though he won it, he was actually up $1.9 million and lost over $900,000 in the last. Here, I need to pause this here. Okay, I'm going to pause this tape here. He actually lost $900,000, I believe, in the last month or two, and still won that contest with almost 1.1 million, and starting with 10,000. And he was one of the big success stories coming out of, I guess, Robbins Trading is the one that does it now, if that's the same company that did it back then. So as I have 2 minutes left here, here is a point in time. Now if this is a 0 point right here, I'm just going to mark the chart, and you say, alright, I'm going to make this my 1 point. Well, personally, I want to see it come at least down to the highway and touch. This is my highway. This is my proprietary highway signal. I want to see it come down into the highway, because I really want to see it retest this low and form that 2 point, right? So we have a 0, a 1. This is wave theory, just basic wave theory. You're trying to catch waves 3 and 5, when wave 3 starts and when wave 5 starts. So 2 point going from 2 to 3, and 4 point going 4 to 5. So let me pause and move forward here in the tape with my last minute. Alright, this is good enough to show this particular. So what we see here is, if we would just define this area right here, yeah, this is the area that I'm saying we're going to curve fit it in and optimize the trading strategy so that we can catch this trade coming out of here. Now if I'm looking for a market to retrace back to this is part of your trading strategy, right? I'm looking for it to retrace back into my highway before it makes that move up. This is what I would classify as a wave 1 runaway, and it just took off too far too fast. Looking over here, it moves into the not enough room for profit to initiate the trade, because it just took off on you, and you sit back and you think, dang, I messed that trade. And I guess this is what I'm getting to in my last couple seconds here is that be careful when you're optimizing your trading strategy. Dave Knight here at Guest Knight Capital Management. We'll talk to you a little bit later. Just a one-on-one fireside chat.